Today I want to show you a tech company that has more potential than NVIDIA, and that company is no other than TSM or Taiwanese Semiconductors. Now TSM is a Taiwanese company located in Taiwan, and that is the one pure reason why the company is trading so low. The long-lasting tension between Taiwan and China. As to put it in simple terms, if China invaded Taiwan, the stock would plummet to zero, and that is the reason why many investors are afraid to invest into TSM. But otherwise, it is a perfectly healthy business and a goldmine for ones who are positive enough regarding the situation. Now, what I want to do today is evaluate the company's fundamentals and figure out its intrinsic value using our 4 valuation models, which by the way you can always download in my Patreon in the link in the description. But now let's get to evaluating the company. So let's go to our stock screener and plug in the ticker TSM, and all the metrics will show up automatically. Now the first thing that catches our eye is that Taiwanese Semiconductors has a dividend yield of 1.52% with a dividend payout of $2.46 per share per year and a trailing free cash flow payout ratio of 87.25%, which is a very high free cash flow payout ratio for a company that operates in the tech sector. So this is something we will watch out for when doing the evaluation. Now we can also see that the analysts have a price of $167 per share by the end of the year. The company is currently trading at 162.55 cents, which is fairly close to the analysts' predicted price. We can also see that the beta of the company is sitting at 1.09, which means that the company is fairly similarly volatile to the S&P 500. But now let's get to evaluating the fundamentals. So we will jump to our 9-pillar analysis and we will have a look at the 9 pillars, including the financials below. So if we have a look at the 9 pillars, we can see that currently 2 of the pillars are sitting in the red, and that is the 5-year PE ratio, which should ideally be sitting below 22.5, but it's currently sitting at 24, which I don't find much concerning. And the second red pillar is the long-term liabilities over the 5-year free cash flow, negative dividends, which should ideally be sitting below 3, but for TSM it's sitting at 5.71. Now what this essentially means is that TSM would take about 30 years to pay off all their long-term liabilities with their current free cash flow, and that is while paying out the same dividend as they are doing now without any dividend increases. And this of course is tied to our very high trailing free cash flow payout ratio, and that is the reason why I think that TSM would be better off without paying any dividend, so that they can invest their free cash flow into their business and into lowering their long-term liabilities, or for example buying back shares. Now, other than these 2 pillars, we can see that all the other pillars are in the green. We can see that they have been growing their revenue, they have been growing their free cash flow, and they have been growing their net income by very high percentages year over year. They also have consecutive dividend growth sitting at 6.55% year over year, and the price to free cash flow sitting at 2.30. Now, whenever the price to free cash flow value and the 5-year PE ratio value are far apart from each other, it doesn't make me too happy, as it essentially means that the company are altering their earnings in the back end, or that something that shouldn't be happening is happening. So that is something to always look out for. But if we look past this and scroll down to the financials, we can see that the PE ratio has been going down slightly over the past 5 years. On average, we can see the trend line in red. We can see that the gross profit margin has actually been increasing, which is great. And if we scroll further down, we can see that the revenue and net income are both growing. The shares outstanding are staying the same. The free cash flow is increasing, which is great. And if we scroll further down, we can see that the long-term liabilities are actually increasing at a very, very high rate. So again, this is quite a big red flag for me, as the company doesn't seem to have enough free cash flow increase to cover their long-term liabilities, as well as cover their increasing quarterly dividend. But now let's jump to calculating the intrinsic value of TSM, and as always, first using the Graham's formula revised. So we'll take the earnings per share of the company, we'll take the base PE sitting at 7, the 5-year growth estimate sitting at 14.67, the growth rate multiplier sitting at 1.5, average yield on A corporation bonds, and the current yield on A corporation bonds, which I adjusted slightly to be more similar to the short-term average. And the reason for that is that the current yield on A corporation bonds is very high, and the intrinsic value essentially always comes out much lower than the current trading price of the company. And if we do this model, we get an intrinsic value of $166.33, which is 2% higher than the current trading price. Not much difference at all. But now let's jump to our second valuation model, which is the discounted cash flow model. And here we will evaluate TSM based on its free cash flow growth. And as we can see, if we take the historical 5-year free cash flow growth, the average growth rate is sitting at 34% year over year, which is a phenomenal growth rate. And if we have a look, the analysts do project a growth rate of 14% every single year over the next 5 years, and I project a very similar growth rate of 15% year over the next 8 years or so. And using that growth rate, I will calculate the future free cash flow, and then plugging a discount rate at 12%, I will get a present value of that future free cash flow. Now, the reason why I plug in my discount rate so high is the tension between Taiwan and China. I do want my return to be a bit higher when the investment is slightly riskier. So after plugging in the discount rate, we will get the present value of that future free cash flow, and after applying the discount method, I will get an intrinsic value of $268.62, which is more than $100 higher than the current trading price, showing that TSM really has very good free cash flow growth. And now let's value TSM compared to its peers, and these two peers will be ASML and NVIDIA. So I will take these two companies, I will take their stock prices and their earnings per share and get their PE ratios, which I will average out to get an average PE, which I will then multiply by the earnings per share of TSM and get an intrinsic value of $317.37, which again is much higher than the current trading price of the company. And now to get to our final model, the dividend discount model, we will take the dividends over the past 5 years and calculate the average growth rate to be sitting at 6.55%. Now I project a growth rate of 6.5% into the future, and then using the WACC, we will get an intrinsic value of $200.58, again quite higher than the current trading price. And now we can finally jump to our ultimate valuation, where we will average out the 4 valuations we just did. We'll switch the alternative dividend discount model to our dividend discount model, and we'll get an intrinsic value of $238.23, which is 46% higher than the current trading price. So say if we plug in a margin of safety of 30%, we would still get a buy at $166.76. Now, I'm not saying that you should or shouldn't buy TSM. I'm just trying to teach you the process of evaluating a company. And so if you did enjoy the video, make sure to leave a like and let me know down in the comments what you think about Taiwanese semiconductors. Also, if you want to download these spreadsheets, again, you can do so at my Patreon in the link in the description. With that, thank you for watching and see you next time.